You, Al.
Welcome, everybody, to our part two of the ABCs of QCDs with our very own Jim King. Um, Thank you for being here with us. Today, we're going to be talking about a case study that will help us situate all the theory that Jim went over with us 2 weeks ago, so we can understand how do we put that into practice. I'm hoping that Jim can start with a small overview of the case study. For those who have not seen the case study, we'll be posting it in addition to the recording later on so people can see it. And then I'll be asking Jim some questions about that case study, and we'll also open up the floor for more questions from the audience. Jim, thank you again for doing this. This is very generous of you, and the floor is yours.
Thank you, Elle. Well, as I learned many, many years ago when I was a Peace Corps volunteer teacher in Micronesia, it's always good to do a brief review of what the material you covered last time. So I'm just going to take a couple of minutes to hit the highlights of our first session. Our first question was, why should we do a QCD? And we said, well, when you look at all the alternatives of what you can do with an IRA distribution, because QCDs, qualified charitable distributions, only apply to IRAs, not to 401ks or any other retirement plans, only to IRAs. What can you do with an IRA? Well, you either are going to take it out while you're alive, and once you reach your required beginning date, your RBD, which now is age 73, you must make minimum withdrawals, required minimum withdrawals or distributions, RMDs. So you can take that money and you can spend it, or another possibility, you can do what we call the qualified charitable distribution, the QCD, and send some of that money directly to a charity, which will reduce your top line adjusted gross income, your AGI, above the line, as the accountants say. And there are some real wonderful tax benefits associated with that and the ease with which that can be done. Who's eligible? Well, actually, you don't have to have reached your required beginning date of 73. You can begin to make QCDs once you reach 70 and a half. So the year in which you reach 70 and a half, you can make a qualified charitable distribution. What's the dollar limit? Well, on an annual basis, that limit actually was recently bumped up at the end of 2023 to $105,000 per year per person. So a couple could give as much as $210,000 if they each had IRAs. And that can be more, the 105 can be more than your required minimum distribution. That's just a dollar limit, regardless of whether you have an RMD or not. And as I said, if you're 70 and a half or 71 or 72, you don't have an RMD yet, but you could still make a QCD up to that 105,000. There's no lifetime limit, and it does not carry over. It's just year by year, each year. How does that affect your taxable income? As I said, it reduces your AGI by dollar for dollar. It has it is not, you don't need to itemize. That was the other question that came up. Do you need to do itemized deductions? Like typically if you're going to do itemized deduction charitable contribution, you have to itemize in order to use that. But with a QCD, you can take a standard deduction and still do a QCD and get that benefit on top of the standard deduction. So for some people, that can be significant. Married couples now in 2024, the married standard deduction is $29,200, I believe. And if you're over 65, there's an additional $1,500 per person. So you may not have a lot of other itemized deductions. And with the SALT cap, the state and local income tax cap of $10,000 per taxpayer, a lot of folks don't have it. And if you don't have mortgage interest or other deductions, you might want to take the standard deduction and then do your QCD on top of that and get actually a bigger overall deduction that way. What is the impact on QCD on my RMDs? Well, it offsets your RMD dollar for dollar up to your RMD. As I said, you can actually contribute more than your RMD, or you can contribute when you don't have an RMD, as long as you're 70 and a half. But to the extent that you've reached your required beginning date, you're making a QCD, it's going to offset your RMD, your required minimum distribution, by the amount of your QCD. So if someone has an RMD of $100,000 and they make a $50,000 QCD, well, $50,000 then they would take as their RMD, and they would have to pay tax on that. But the other $50,000 that they had sent off as a QCD, they wouldn't have to pay any tax on. What charities qualify? Any 501c3, like EBCF, for example. So as long as it's a qualified charity, and the money goes directly to that charity from your IRA, very important, it doesn't go through a third party, it goes directly to the charity, that qualifies as a deduction. And on your tax return, you list your RMD, for example, you list the amount of your QCD, there's a line to do that, and you enter the net as your taxable portion. Okay, so who can benefit from this? And I put together a little case study for you, which I'm going to go through because maybe not all of you have had the chance to prep and read it. And this is, as Elle said a moment ago, this is kind of what we consider to be a upper middle client situation. That is, these aren't our very highest, ultra high net worth clients, but these are people who obviously have some means. They're older, obviously, because this is who it applies. The QCD applies to people over 7.5. So we're going to talk about Mr. and Mrs. Smith, a married couple, both age 73 this year. So they both reached their required beginning date. They've been married 48 years. They have 2 children, a daughter age 47, a son age 45. This is going to be for some later discussion about alternatives, just a little background on the family. The daughter's married, has 2 children ages 22 and 18. Son was divorced, then remarried. He has a son age 23 and 2 stepchildren ages 16 and 12. The 2 older grandchildren have graduated from college, while the 18-year-old is a freshman at a community college. The 2 younger ones are still one's in high school, one's in middle school. So thinking about education planning there, we'll get back to that later. Mr. Smith owned a business for which he sold 3 years ago, at which time he retired. His last payment from the buyer was last year, so no more payments in 2024. Ms. Smith also retired 3 years ago from the consulting firm at which she had worked for many years. They both deferred taking Social Security retirement benefits until age 70 in order to maximize the amount that they would receive. They've owned their home in the Bay Area for 35 years, paid off the mortgage 3 years ago when they retired. Their home is worth approximately $2 million, and the cost basis is $400,000. So again, we're thinking estate planning here and how to avoid paying tax should they decide to sell their home. They also own a rental property currently worth about $800,000 with a $200,000 mortgage. It generates about $2,000 a month in annual cash flow, about $14,000 of which is actually taxable because they've got some depreciation to offset some of that positive cash flow. Other assets include a family trust worth about $1.5 million with a cost basis of $650,000. And most importantly for our discussion this morning, 2 IRA rollovers, his worth approximately $2 million and hers worth $1.5 million. They also have personal property worth about $150,000, and they have no liabilities other than that rental property mortgage of $200,000. Because they delayed their Social Security, they have substantial, taking their Social Security retirement benefits, their benefits are substantial, about $90,000 for the 2 of them before Medicare deductions. Now, Medicare deductions are about another $15,000. Because of their income, they pay a little more for their plan Part B and Part D than the minimum amounts. Their RMDs, I calculated this for you. Could have made it a little more interesting if I asked you to do that, but I went ahead. Their RMDs, his will be about $75,500 this year, and hers will be about $56,600. So that's pretty substantial. And then they'll have interest and dividends from their trust of about $45,000 on the $1.5 million. Their household expenses are about $12K a month, not $12 a month. Sorry about that typo. $12,000 a month, and then they're still traveling. They have an annual travel budget of about $20,000. Their accountants told them to expect to pay about $41,000 in federal income taxes. That's a 24% bracket, and I factored in the deductions and so forth. This is before any QCD. and $7,000 in California state income taxes. That puts them in a 9.3% bracket. So that's our background. And then there are some questions, and I'll turn it back to Elle.
Well, I'm going to read from the standard questions that we prepared for the case study, and then I encourage the audience to post their questions in the chat, and we'll get to them. You don't have to wait until the end. You can post your questions as they come up. This is an interactive session, and we are here to answer your questions. So, Jim, how much is their excess cash flow expected to be for 2024?
Right, and of course, that's a key question because for the most part, any QCD that somebody makes is going to be out of their excess cash flow. We're not asking people to reduce their standard of living or their lifestyle. So when we look at their cash flow, obviously we look both at the inflows and the outflows. And their inflows, I mentioned in the case study, they've got Social Security, which is $90,000 less the $15,000 for Medicare. So that's about $75,000. Their RMDs, which come out to just a little over $132,000. Their interest and dividends, it's about $45,000. And then their real estate cash flow of about $24,000. That adds up to $276,100. So just rounded $276,000. Then their expenses, well, we said $12,000 a month for household expenses. That's $144,000. Their travel, that's another $20,000. And then their taxes, $48,000. $41,000 federal, $7,000 for the state of California. That adds up to $212,000. So their excess net cash flow is about $64,000. Now, since that's less than their RMDs, remember, were $132,000. That money is then available to do something with.
And so what are the potential uses of that excess?
Right. So if they want to spend that money, of course, that's one thing. They may want to, I've assumed they've taken that money out and paid taxes on it. So this is after tax cash flow they can spend. They could gift to their grandchildren. They could use a 529 plan for the kids, the two younger grandchildren, one in high school, one in middle school. In fact, if either of those are going to a private school, they could put up to $10,000 or use up to $10,000 toward private school cost for pre-secondary and secondary education, pre-college education. More likely, we find that our clients are thinking about putting money in a 529 for college expenses. We've got one still in college, it's a freshman, but then we've got the two younger ones. So that's another possibility is to look at, does it make sense to put money in for a 529? Now, the thing we're talking about, of course, is, well, what if we have some charities that we'd like to send some money to? So we could use up to that $64,000 to go to charities via a QCD. And that could come out of one or both. Well, it would probably have to come to some degree out of both, although his RMD is $75,500. So literally he could fund 100% of that $64,000 out of his RMD if the wife didn't want to, or hers is 56.6, so she could not do 100%. Most likely what typically happens is each member of the couple has charities. Some they want to fund jointly, and then they may have some that they want to do individually. I know my wife has certain charities she likes to benefit. I have others that I do. And then we have those that we do together. So you make your philanthropic budget out. You determine who you'd like to send to, how much is going to come out of his, how much is coming out of hers. So up to $64,000 is available, although there's a little caveat here. If, in fact, some of that goes to QCD, what does that do to their tax liability? Well, it reduces it, doesn't it? Let's say, for the sake of our illustration here, that they feel fine about the grandkids' education, the kids are doing fine. They're going to take that $64,000 and do QCDs with that. Well, what does that do to their tax liability? Well, looking at their marginal tax brackets, 24% federal, 9.3 state, let's just simplify and say it's 33% on the margin. And we don't, because they're not being able to itemize their their state taxes above, their total taxes above 10,000. They got real estate taxes, so their SALT is capped at the 10,000. So there's no worry about offsetting state taxes against federal taxes. They're not going to get any excess deduction there. So it's a simple process of saying, all right, 33% is their combined marginal tax bracket. So if they contribute 64,000, what's their tax savings? Well, about a third, so roughly $21,000, 1/3 of 64,000. So if they're making a $64,000 QCD total, they're going to save about 21,000 and a smidge in combined federal and state income taxes. Well, now they got another 21,000. Okay, so once again, now what do they do with that? They could actually make a bigger QCD contribution if they wanted to, and save still more taxes, and have a little bit of extra, not as much, but then a third of 21. Now they got another 7,000 in tax savings to do something with. Okay, or more likely, they take that 21,000 and that they take the grandkids on a great trip, or they put some in a 529. So you see how this works iteratively. Every time they make a QCD with their excess cash flow, they're creating more excess cash flow from the tax savings.
So how much maximum could they contribute to the QCD from their excess cash flow without exceeding their RMDs?
Right. Since their RMDs are up at, what did we say, 132,000, I said? Yeah, 132,000. Well, they could do 64. They could do another 21. That puts them up to 85. And you see, iteratively, they could do marginally a little bit more. So the final number is somewhere slightly north of 90,000. And still not exceed their RMDs, nor, although again, they don't have to worry about that, not exceed their dollar limit of 105,000 per person is really the issue there. But also not have to reduce their lifestyle, not have to, it's all coming, that increase in their ability to make more contributions is coming out of their tax savings. It's not coming out of their household expenses or their travel expenses. Those are 144 and 20. So that's 164,000. And remember, we said their gross cash flow was 276,000. So 164, 276. So that's actually, it's $102,000. Now they can't reduce all that because they can't get, and of course, as they reduce their taxable income, their marginal tax rate is going down too. But safe to say, they can do more maybe than they thought they could, in excess of $90,000.
So can we run one more time over their tax savings?
Mm-hmm.
If they did the total maximum, can you just go over how you calculated that number?
Sure. So their basic tax bill, as I said, $48,000. That puts them in a federal tax bracket of 24%, and a California tax bracket of 9.3. For every dollar they put in, or that they distribute as a QCD, qualified charitable distribution, that's going to save them 33 cents in taxes. Okay, so at the first level, we said their gross cash flow less their expenses, including full taxes of $48,000, left them net cash flow of $64,000. So certainly, any of that's 64, even if they got no tax benefit whatsoever, that would still not require them to reduce their lifestyle. In other words, that's just extra after-tax money. So as I said, if they took that 64 and they spent it, or they gave it to their grandchildren in a 529, or they did something that did not generate a charitable deduction, it was simply consumption of one form or another, or savings. They took it and just added it to their family trust. They still have that $64,000. That's excess current year cash flow. Doesn't affect because none of that would be deductible, does not affect their tax liability of $48,000. But for every dollar out of that $64,000 that they used as a QCD, they're going to save 33 cents on taxes. And why 33 cents? Because their marginal tax bracket is 24% federal, 9.3 state. Let's just say 9. 9 and 24 is 33. So send $1 QCD to EBCF. Now their tax liability, instead of being $48,000, is $47,999 and 66 cents. Okay. In other words, they've saved a third. It's going to reduce their tax liability by a third. So in my example, here, if they did all the 64,000 to various charities, doesn't have to go to one, it can go to as many as you want. How much would that save them in income taxes? Approximately a third of 64,000, or roughly $21,000. Okay. Well, now, even though we gave away 64,000, we've still got 21,000. That's my tax savings. So that tax bill, instead of being 48,000, is now 27,000. Now, we have to be careful here because the tax brackets start going down as we reduce our taxable income. So we're not going to get a full 33% savings the further down we go. But I'm really just illustrating the point. You'd have to actually, get a sharp pencil and say, okay, how much if we do 30,000 QCD? How much if we do 40,000, 50,000, 60,000, 64,000? Now, 64, because their taxable income, I figured that out, was because they get some deduction from their real estate. They don't pay full tax on the real estate, and they only pay tax on 85% of their Social Security benefits, not 100%. And California state, they don't pay any tax on their Social Security benefits. That's something you may not know if you're not at that stage of your life where you're receiving Social Security and paying taxes. But yeah, so Social Security in California is tax-free, income tax-free. So if your federal taxable income is $300,000 and nothing else changes, your state taxable income is, in this case, $210,000. You don't pay tax on that $90,000. And for the federal, only 85% of your benefits are taxable. So, as I say, as we make charitable contributions via QCD or any form of deduction, our tax bracket is we fall into lower brackets as we go. So we actually, as I say, use the sharp pencil. But the general idea is, if I give away my excess cash flow at my marginal tax rate, I'm going to save X. And in this example, that's roughly a third. Now, I've still got the 20, I could actually give away more. I might not still get a full 1/3 deduction. I might get, or savings rather. I'm still going to get 100% deduction, but it might not be worth a third because my marginal bracket might go from 33 down to 30 and then down to 27 and so on and so forth, depending on where I am on the brackets. So we have to look at that. And we're not likely, as I say, we're not going to exceed the 105,000. I've never had a client who exceeded the 105 per person for a married couple. But I've got clients who between them give over 100,000, give over 105,000 between two people. Did that answer the question, Elle?
It did. I think this was really good to be able to go over these numbers one more time for those who just want to let it sneak in. I have one final question, and I encourage the audience to post their questions or raise their hands so we can hear from them. And then also my colleagues who are supporting donors to also ask their questions. What other ways could they choose to make charitable contributions, and what would be the tax and cash flow implications? And you touched a little bit on that earlier, but if there's anything else you want to add to this.
Yes, I would. And now we're going to go back to something we actually mentioned in our first session. You do have to be 70 and a half to do a QCD. What if someone is 68 or 69? What if I just change the ages of Mr. and Mrs. Smith? And What if Mr. Smith still owns his company and he hasn't sold it yet? Or they have in their family trust, they have some publicly traded stock. So they have, and they have the real estate. So the point is, if you have an appreciated asset, you can't do the QCDs yet. And in a year, in which you expect that you may be forced to realize a capital gain, like on a sale of a business or a sale of a real estate property, or simply you have a portfolio that has long-standing appreciated securities and the appreciation is substantial relative to the cost basis. You bought some Apple stock 20 years ago, okay, and now it's worth 50 times what you paid for it, and that's not out of the realm of possibility. Well, EBCF, of course, has a wonderful program. It's called the Donor Advised Fund. And I'm a participant. I have 2 donor advised funds at EBCF for different purposes. But I use that because I do have appreciated securities. And particularly for a business owner or someone who has an impending large capital gain event, a sale of something that they've owned typically for some period of time. Now, this does require some extra planning over and above what we've done here. Now, the great thing about QCDs is it's just every year it's a standalone, and you've got your RMD, or you've got the ability to take money out every year. It's going to come out as cash. So all you have to do is sell something in your IRA. And when you do that, of course, do you pay any tax? No. So you can sell something, not to pay any tax, and then cash is going to go directly to the charity, which the charity loves, by the way. They love to get cash. Because if in this example I'm giving now, let's say I've got 500 shares of Apple stock and I want to give 100 shares to EBCF or to some other qualified charity. But let's say I don't want to give it all right now. I'd like to pace it out over 5 years. I want to give it to my church, but I don't want to give the church a one-time donation of $100,000 because then they're going to expect me to give $100,000 every year. But I wouldn't mind giving them $10,000 a year for 10 years or $20,000 a year for 5 years. Well, I can set up a donor advised fund at EBCF. I can contribute, in the case of the Smiths, so maybe a real estate property, because once again, it's a one-time. And if I've owned that for many years, my basis has been depreciated down. I'm looking at a fairly large capital gain. And rather than do a 1031 exchange, I'm tired of managing real estate. I just want to get out of it. And there are actually a couple different strategies we can use to pull some cash out as well. But the portion that we leave in, we can donate to our donor advised fund. EBCF can sell the asset, whether it's property, stock, any appreciated asset, within limitations. They're closely held businesses. That's another story. It's more difficult, not impossible, but it depends case by case. And then I've got a donor advised fund that, let's say, has $300,000, $400,000, $500,000 in it from the result of this sale. I haven't paid any tax, or if I have, I've managed it so that I pay the amount of tax I choose to pay so that I can take some cash out. But the bulk of it I've put into my donor advised fund. And now on an annual basis, I can advise, because it's a donor advised fund, I can advise EBCF to make contributions out to the charities of my choice. And by the way, my donor services advisor is going to help me find really vetted and well-qualified charities that address the concerns that I have. Might be early childhood education, might be equal opportunity and a number of different areas, housing, let's say. So if I have kind of a generalized interest, EBCF donor donor services advisors can help me vet and select individual nonprofits to whom I can then advise a gift. So that's I think a great alternative. It's one I've used myself, one I've advised many of my clients to use with great satisfaction.
Thank you. You've been very generous to us, Jim, and you've also been very generous in the advice that you give to fellow donors and former professional advisors. I don't see any additional questions in the chat. I think you've made a great, compelling and thorough presentation. I want to offer one last chance for anybody to come off mute and ask their question if is still lingering. Otherwise, we want to thank you again, Jim, for this great opportunity to learn more about how to use those QCDs. We'll be following up with an email, kind of a wrap up on the series. And if you have ideas about other vehicles you want to learn more about, please reach out to us. We would be happy to think about creating another set of educational series for you on those topics. If you are also inclined to do your own presentation with us, so you can talk about your expertise in one of the areas, we're also very happy to feature you and work with you to make a presentation. And with that, I want to thank everybody for joining us today. Jim, it's always a pleasure being with you. And thank you to the team who's done a great job, and have a good day.
Thanks, everyone. Aloha.
Thank you, Jim. This was great. I
You're welcome.
appreciate you taking time out of your vacation. This was amazing. And we have a number of folks who couldn't make it today that are super excited to watch the recording. So thank you.
Great.